Toronto Stock Exchange and TSX Venture Exchange. And I'm really pleased to be here today with several of my colleagues who you're going to be hearing from over the next hour, hour and a half. As importantly, and probably more importantly, really pleased to be here with several experts who are going to spend some time talking to you about a concept that isn't necessarily really well known in this market, but is a hugely important source of capital for funding and growing early stage businesses. You'll see by the title of our event, we are calling this a public venture capital introduction. And so what I want to do is explain a little bit in my opening remarks what public venture capital is. And as I said, this is a term or a concept that isn't as well known down here, but let's be very clear. Hundreds and hundreds and hundreds of early stage companies raise billions and billions of dollars every year using public venture capital. And so while it may be something that you're not familiar with, it's something that lots of companies are familiar with, including many from the US and indeed from California. So what we're going to be doing over the next hour and a half is three very simple things. First 20 to 30 minutes is going to be a panel discussion with a lawyer, an accountant, and one of my colleagues as we talk about some of the basics, understanding a little bit what this thing called public venture capital is. The second segment is going to be a discussion between me and a company that has recently used this as a funding tool to grow their business. We're going to chat about why they've done this, some of the lessons learned, some of their experiences, things they did well, things they didn't do well, things they liked, things they didn't like. And then we're going to conclude with a final 20 or 30 minute session talking about some of the best practices of using this market effectively and how to access it. And that's going to be a discussion with a couple of investment bankers who spend their life helping companies raise capital in this form. Before we get into this, I want to go through 3 or 4 key building blocks, just so that everyone around here has the basic understandings of a few key things. So, first thing I want to cover off is the most simple question. What the heck is public venture capital? Public venture capital is a source of equity capital. It's not debt. It's not convertible debt. It's not preferred shares. It's equity capital. That's the very basic. Where does the money come from? Everyone here will know what venture capital is, or sure as heck hope you all do. And you know where venture capital comes from. It comes from VC funds, obviously. When you're raising public venture capital, you're not raising money from 1 or 2 VC funds. Instead, you're raising money from typically hundreds of investors. And those investors are individuals, family offices, pension funds, institutional asset managers, and sometimes VC funds. But the big point is it's capital from a broad pool of capital providers, not coming from one single source. So you know what it is, you know where it comes from. Who's using this? This is probably the most important question. Who is using this kind of capital? And the answer to this is both complicated but also pretty enticing, because it's a broad range of companies. What you're going to hear today is that companies with as little as $2, $3, $4 million in revenue have and do successfully raise public venture capital as a means of growing their business. But if you're bigger than that, that's okay too, because companies with 5, 10, 20, and 50 million in revenue also use this source of funding to grow their business. And are you bigger than that? That's okay too, because we've got companies that have hundreds of millions in revenue that also raise this sort of money. The dollar amounts that are raised vary. In some cases, companies raise $1 or $2 million. That's it. In other cases, they'll raise tens of millions. And in other cases, they'll raise truly hundreds of millions. So if you liken this to the concept of venture capital that you all know, it's like that grading from Series A to Series B to Series C. Smaller companies raising smaller amounts, bigger companies raising bigger amounts. And so hopefully everyone in this room fits into one of those various categories, small, medium, or large, but all of you should be able to understand the different ways in which you could possibly make this a funding source for you. Common theme about who uses this is almost exclusively people using public venture capital are doing so as a means of raising growth capital, of growing their business. Capital for acquisitions, capital for acqui-hires, capital for other forms of growth. It's typically a growth vehicle. All right, the next question I get asked a lot, and and the most important question for a lot of this conversation is, how do you access this money? And I want you to stay with me here for the next 2 seconds. You access public venture capital by going public. That probably doesn't surprise you given that Toronto Stock Exchange putting this on. But the reason I want you to stay with me is because a lot of times when I talk about going public, especially Americans will tune out, because the concept of going public in the US is a concept that is almost exclusively reserved for mega cap companies. It's what Snapchat did a couple weeks ago. It's what Google does. It's what Facebook did. It's what Twitter did. It's what LinkedIn did. Mega companies go public, not small companies, or at least that's the mindset. What we want you to understand is that we are happy to see mega companies go public, and we've got plenty of unicorns that have gone public. The most recent and big name that is well known around the world is a company called Shopify, which many of you will know, that went public with us a couple of years ago. It's a multi-billion-dollar business. We're happy if any of you are that size to talk to you, of course. But we are also equally as happy to talk to you as a smaller company. And that's the unique thing about our market, which is that you can be a very small company and go public. The costs are a lot lower than they are in the US. The timelines are a lot shorter than they are. The overall regulatory burdens are a lot lower. What that means is that when I said a few seconds ago that you access public venture capital by going public, you don't have to panic and run away in fear of the horrific regulator who's going to be overseeing you. There is a path here that is proven and works. The final thing I want to say in terms of my introductory remarks is answering the question of, does this work? No point raising capital if you can't grow your business successfully. No point raising capital of any form if you can't build yourself into something bigger. And the answer to the question of does it work is absolutely yes. Today, if you look at the companies that are using public venture capital as a means of growing and scaling their business, in Canada there are over 40 of those companies that have reached either market values of $100 million or more, or $1 billion or more. So over 40 companies have successfully scaled to that kind of scale. And that's today. If you look over time at people who have used this market, dozens and dozens and dozens of companies have successfully scaled their business to being worth over 100 million, or indeed to get that magic unicorn level. You can also use this to successfully exit your company. There's no reason why this has to be a path that ends in you remaining public for the rest of your life. Dozens and dozens of companies have used this as a successful vehicle to scale their business to an eventual sale to Apple, to Facebook, to Twitter, to PayPal, whoever it may be. And there's lots of examples of that as well. So I'm going to leave you with that as my introductory and welcome remarks. Keep all of these points in the back of your mind as we're talking through the sessions today, because I think it's really important that you understand how this can be helpful to you. Final things I want to say is a big thank you. The logos that you see on the screen right now are all people who have helped put this event on. Canaccord Genuity and Echelon Partners are two investment banks that you're going to be hearing from later today. EY, of course, major global accounting firm. Both those in Norton Rose, big law firms. Each of these has been very generous with their time, very generous with their money to help put the event on today. So we're very grateful for them and owe them a big debt of gratitude. They're also all here to help you. And so certainly during the session, they're here to help, but also after the session, they want to help, they want to talk to you, so please look out for them. Finally, the names at the bottom of the list have all helped promote this, and to carry that conversation forward, I want to introduce my colleague, Dylan Gittleman. Dylan leads our business for us in California. He's based around here, and Dylan will briefly say a few words and then give a thank you to the partners themselves.
Hello. I'm the VP of Capital Formation, located here locally in Palo Alto. I joined the exchange in August, and I joined the exchange because I've been in the market for years. Some of you might remember me in the 90s. I was part of the exchange, came out of G Capital, came up to Silicon Valley, was part of that boom and bust. Had fatigue being an entrepreneur or being part of an entrepreneurial team, went back to big companies. And about 7-8 years ago, wanted to get back in it. And for the last 7-8 years, I've been representing foreign service providers launching in the Valley. And early in the summer, Enzo, who's one of the our local partners from equities.com, said, Dylan, you know, the exchange is looking for somebody to represent in the US, and they're really looking to expand. And I said, you know, I've heard of the TSX Venture Exchange over the years, and as a matter of fact, prior company I was representing, a foreign service provider providing valuations and research, there were several companies that went public on the exchange. So I talked to some of the founders of those companies, and they had a good experience. And I think what you have here is, it's an alternative to traditional venture capital. It's a complement, a supplement. I see there's a few VCs in the audience here, and you'll probably agree with me, not every company is right for venture capital. And in some cases, you're aligned interests. In other cases, you're aligned interests, and the interests differ as you go down the road. And one of the pressures I've seen over the years, I've also been a board advisor. I'm currently a board advisor to a Stanford, out of the Stanford Codex program. And what we've seen is, to raise capital, you have to grow at 30% plus a year. In some cases, that type of hyper growth to an early stage company does not make sense. And what happens is, you chase business, you buy business, and your product is half-baked. And what you really do is you blow up the company, because you're really not ready to grow at that rate. You really need to slow growth. And if you're a company that you have you're selling into a complex market, you really need to focus on what the customers need, and you gotta make the product correctly, make it correct, and then go to market. And so the exchange offers an opportunity to raise capital from a diversified pool of investors that do not have the pressure that the VCs have, where they want to see a company grow to 150 million within 5 years. And so you could be a successful company, much slower growth, 10, 15% growth a year, and raise capital via the exchange. Now, can those companies be extremely successful? Yes. We have experiences on the exchange. TO Networks, meaning uncle in Spanish. TO Networks came to the exchange 17 years ago with 1 million in revenues, grew to 75 million. Any VC would look at those numbers and say, you know what, if we would have invested in the A round, you would have never received a B round. You're growing too slow. That same company, February 15th, got acquired for 4 times revenues. So you can be a slower growth company and still be extremely successful. The other thing, quite often you'll see that is not in line, is the VC is looking to maximize the money they can make from your company. And in some cases, by the time you hit the B round, you've given up over 50% of your company, and suddenly they own the board, they decide what to do with your company. They may decide to sell your company prematurely. You might be in your late 20s, early 30s, and you really dreamed of being the CEO of the company, and you really feel that what they want to do with the company is not right. Well, with the exchange, there will not be that pressure where these investors are going to say, okay, sell the company. It's, you keep control of your company. And so that's what I like about the exchange. And when I heard about the opportunity, I said, you know, I'd be delighted to represent the exchange, because I've been in the shoes of an entrepreneur and seen what could happen. There's tremendous benefits with VCs, but not every company can benefit from the VC money. Some companies just need capital and time. And so what I'd like to do now is introduce the local partners that help make this event successful. And they've marketed the event to their association members. We have from V Labs, that's MIT, Stanford V Labs, Fred Stein, please come up. And maybe you could, here are the stairs over here. Maybe you could, well, you could come in and maybe tell a little bit about your organization.
All right, thank you. First of all, thank you, Dylan and Maureen, for reaching out to us. We are VLab, and it's vlab.org if you want to look us up and learn more. We produce events, 10 events a year, and each one we feature what we think is an important disruption before it's cocktail party conversation, but where it's close enough that it's really going to have impact. And we feature 2 early stage companies, A-round funded, so they're going to be real companies, and we hope, and we have had several successes, like Yahoo, and more recently Nirvana was acquired by Intel. So the next event we have is later this month, the 25th, and it's going to feature the disruptions in networking. So we're kind of saying, watch out, Cisco and Juniper, these people are going to impact you. And then we also have an event just for a very small segment of the audience that would be people that are in the growth stage. And it'll be a very restrictive event. So if you're in that phase, see me later, we can talk about that. And again, thank you very much, Dylan and Maureen.
And next, I'd like to thank Royce Law Firm. Representing Royce Law Firm is Heidi Klein. Royce Law Firm is a mid-sized firm in the Valley. I've known Roger for maybe 8 years now. I've referred him companies, he's referred me companies in various capacities. And excellent law firm. If anybody knows Roger, at first I had no idea he was a lawyer. He's like a BD guy like me. He's at every event. I don't know when he sleeps, when he does work, has a lot of hustle. But here's Heidi, she's part of the team.
Thank you, Dylan. Thank you, Maureen. It's great to be here, as always, to support these events. So Royce Law Firm is a full-service firm, and we have a wide variety of clients, although we do have a special set of skills and resources that address the particular needs of early stage and small growing companies. Our major practice areas are corporate insecurities, international and cross-border tax transactions, intellectual property, which we've just fleshed out by including, we just acquired a patent for last fall, employment and wealth strategies. Our headquarters are just a couple miles down the road, and we have additional locations in San Francisco, Los Angeles, and we just opened another location in Orange County. I practice with the IP group, specializing in technology licensing, trademarks, privacy, and brand strategy. And we also have here tonight Lisa Chapman, who is head of our employment group, specializing in counseling and litigation. If you have any questions about our firm, our practices, or any of our other areas, we'd be happy to talk to you. Thank you, and enjoy the event.
Okay, and now I want to thank GSV Labs for providing the space. They're an entrepreneur hub. They've helped entrepreneurs throughout the Valley, large companies set up incubators. And originally Marlon Evans, the CEO, was going to speak. So it's funny, I don't know if any of you know Marlon, but he was out on the Stanford football field. He was a running back some years back. And I remember when I first met him, I was getting a ball signed for a friend's son. And next thing I know, some years later, I see him, I'm like, I kind of recognize you. Where do I recognize? Didn't you run the ball for Stanford? And it was the same Marlon Evans. So, but for Stanford, GSV Labs is going to... Right behind you. Oh.
Appreciate it. Unfortunately, Marlon had to run to the airport. I'm Alec Wright. I'm the Chief Innovation Officer here at GSV Labs. We're an innovation hub that works with the community, around 170 startups. Our real sweet spot is kind of seed to Series A and beyond. And so we're really excited about the opportunity to have, TSX and kind of have this conversation in our roof, because it's a beautiful complement to, the stage of startups that we're working with, and a really important part of the conversation. And so, welcome to GSV Labs. It's a real pleasure to have you all here, and hope you enjoy the event.
And is anybody from Equities here? Anybody from Equities? Okay, so I guess they're running late, but maybe Enzo will just take the stage later on. But Equities is Enzo created the services division for NASDAQ, and then went on to become CEO of Equities. Equities provides, what would you say they provide? PR for companies looking to go public or get visibility in the market, press releases, native advertising, and all that. And thanks everybody, and I'll hand them over. Mike.
Okay, so as I said, we've got three important panels that we're going to get going with. We're going to bring the first group up right away, so coming up, gentlemen. Moderating this panel is Rob Peterman. Rob is our Global VP of Business Development for the exchanges, and very fleet of foot, clearly. And with him is James Brown and Bill Damaris. Over to you, gentlemen.
Damaged something there. Thanks everyone for coming today. Just to introduce myself really quickly, I'm responsible for all the new listings on TSX and TSX Venture, as well as our investor development programming. So we run a fairly robust program around the world, London, the US, building the investor base around our companies. It is a mix of good companies and capital that make our world go around. So that's what I focus on. Michael said a lot of great things. I did just want to kind of add 2 points to give a little bit of context to people in the audience, and then we'll jump into this panel. So one is $62 billion. So last year on the Toronto Stock Exchange and TSX Venture Exchange in Canada, there was $62 billion raised. If you look around the world, that makes Canada the 3rd largest place in the world for raising equity capital. So that is risk capital. Canada is the 35th largest country in the world by population. So we are very good at raising risk capital, more risk capital raised in Canada per capita than any other country in the world. China actually passed the US last year and took top spot in equity capital raised. But people are often surprised to know there's more equity or risk capital raised in Canada than in Japan, than in London or the United Kingdom, than in Brazil. So much bigger countries, more equity capital raised in Canada. Another number I just wanted to mention to people is 255%. So every year on the TSX Venture Exchange, we run a program called the Venture 50. So that's the top 50 performing companies on the TSX Venture Exchange. I'd encourage you to Google Venture 50. There's videos of each of the companies talking about their story, their investment thesis. The average return across those 50 companies was 255% during the calendar year of 2016. So that's another way to kind of get a sense of our markets and the type of growth companies that you see in Canada. So we're going to get into this panel right now, joined by Bill Demers, who's the EY IPO practice lead for Canada. So glad to have Bill here, and James Brown from Oslers, which is a Canadian law firm with offices in the US and other places as well. So first question is going to go to Bill, and Bill, want to just you to give your thoughts. You see a lot of companies, but what are some of the reasons that they maybe choose to go public at an early stage, and what have you observed?
Sure thing. Is it on? Is that on?
Yeah.
There we go. Okay. Thanks very much, Rob. That's a great question. Whenever I think about companies actually going into the public market, obviously the first thing you think about is they want access to capital. And that's probably one of the first things I always think about. But the other thing is the liquidity that you actually have for the shareholders. Being a public company actually affords the owners, the entrepreneurs, the founders of the business with a bit of an exit strategy. And I think that's important because in a lot of cases, an entrepreneur's entire net worth is tied up in their business, so it actually allows them to take some money off the table. The other thing I think about too is, companies have an opportunity to really kind of increase their brand and their profile and their credibility in the marketplace, and that certainly is great for their customers, but it also helps attract new customers when you have that public presence. Certainly when you're a public company, you are kind of afforded the opportunity to have a new currency, so you don't always have to go to the bank if you want to make an acquisition. Michael actually talked about acqui-hires as well, so especially in the technology space, just trying to find the right people is an important thing, and it actually allows you to retain and also attract some really great talent because, again, as a public company, you'll have the ability to offer some options, and those options can be converted into shares, and those shares can actually be liquidated. So, I think those are some of the things I think about when companies want to gain access to public markets.
Right, so I'd just echo one of the things Bill said, and it's just my personal observation from seeing a lot of companies, but that ability to do acquisitions is one of the reasons that you should really look at going public. So enhancing your organic growth with acquisitions. Bill, we're going to come back to you, but we do see some of the companies that come to our market motivated by not wanting to take traditional venture capital. So, talk a little bit about maybe how the public market route is different.
And I think, Dylan actually touched on it in his introduction as well, and that's really, the kind of the investment thesis behind a VC that's putting money into it. They'll come on board, they'll give you some money, and they want to, be with you for a period of time, and it could be 3 years or 5 years. And, during that time, it depends on really what they want. They really do have the ability to sit on your board and make a lot more decisions, and maybe sometimes those are the decisions that you wouldn't make as a founder of the business. And so sometimes what we see is, companies decide to go into the public markets because they have a lot more autonomy. Had a recent case where, a company actually wanted to make another tuck-under acquisition, and so they went back to trying to raise some more money, and, at that point everybody said, look, we're kind of at the end of our hold, and we don't want to cut another check, so either you raise for somebody else, and they said, well, we're just going to go public, because that opportunity actually gave us the opportunity, gave them the opportunity to get into the markets and actually make that acquisition.
So let's get James into the conversation here. James, maybe talk about an example of a company that you've worked with. They were maybe debating the options of, maybe going public at an earlier stage, venture capital. Just talk a little bit about the things you observed working with a customer like that.
Sure, thanks, Rob. So one of the clients I'm thinking of is a company called Profound Medical. They do a medical technology. And they, in 2015, did an RTO, or reverse takeover. So that's the most common way companies will go public on the TSX Venture Exchange, as opposed to the more typical initial public offering route. It provides an opportunity for people to get listed publicly by having a public shell acquisition vehicle acquire the private company in a stock-for-stock transaction. It's typically faster and cheaper than a traditional IPO. It provided the opportunity to get access to a retail network of capital. The acquisition vehicle that they merged with had some cash available in hand because they'd already raised it from retail investors. And as Profound thought about what they wanted to do, it was a cheaper, faster way to get access to sort of seed equivalent capital for them to grow the business and yet have ongoing liquidity for their existing institutional investors.
So let's also try to give people some idea of scale. So Canada is about 1/10 the size of US in terms of population. IPOs or going public in the US is often associated with big or very large companies. Maybe talk a little bit about how scale plays out in the public markets between Canada and the US.
Sure. So we really have two exchanges in Canada that are operated by the TMX group. We have the TSX, which is our large board, and the TSX Venture Exchange. And the difference is pretty remarkable in terms of size and scale. We have an average of about 3,300 or so companies across both exchanges. The TSX, there's about 250 companies that have a market cap of $1 billion or more. As of today, I think there's only one on the Venture Exchange. There used to be more, but there's a lot of commodity plays on the Venture Exchange. So it's smaller profile. There are companies typically in Canada that are in the $50 to $200 million range that trade pretty well. We do have, as I say, some large public companies, but not as many on the venture side. We have a series of investors who are focused on the venture market, and I think that's why the TSX Venture Exchange does so well, because we have institutional and retail support for those companies. We also have faster timelines. As I said, the RTO is a different process than doing a traditional IPO. It's different than the US registration statement, traditional IPO, which can take anywhere from 4 to 6 months or a lot longer. In Canada, we see IPOs and RTO transactions in the 2 to 3 month range from kickoff. So it's a faster process. It's typically a lot cheaper, and there's less market risk through an RTO transaction.
We had a different Canadian law firm that did a study on timeline from filing to closing of IPOs, and the average time for an IPO from filing to closing was 33 days in Canada versus was well over 100 in the US. So if you think about the risk that goes into financing an IPO and what you're exposed to as markets come up and down, that ability to do a transaction faster when the window is there is something that we place a high amount of value on.
This is on? Okay. I'm going to add one quick comment. One of the things we talked about the speed to market too is that period of risk. Don't forget, like most of the senior people are engaged in actually trying to work on the IPO. And so that really takes them out of the business. And so, you really do have two jobs. One is to keep the business going while you're doing this, and the second thing is actually trying to execute on the IPO. So the longer the process, the more risk associated with it.
So let's talk about costs. Everyone likes to know about what the costs are. So put you on the spot, James, if you could give people an idea of what it would typically cost to go public in Canada.
And it's going to depend on a number of factors, obviously, but you can expect it'll cost at the low end in the 150 to 200,000, and at the high end $1 million or more. Now there is obviously the currency exchange benefit as of today, so you can all come to Canada and get a 33% discount on your money, which is helpful. But venture capital itself isn't without its own costs. There's the cost of actually negotiating the investment and the cost of the return provided to the investors. So there is a cost to being a public company, to both becoming public and maintaining an existence as a public company, but the gap isn't as much as some people might expect.
So if the small end, and Michael's talked about, we have big companies in Canada, but the small end of the Canadian markets maybe sounds a little bit like, say, the over-the-counter bulletin board here in the US to people. Bill, can you maybe talk a little bit about how TSX and TSX Venture for smaller companies is different?
Yeah, thanks, Rob. Certainly. When I think of the OTC, I think about kind of a broker-dealer network where you're basically, trying to execute your trades through a broker-dealer network. So kind of the regulation is not quite as, as formal as we'd have under the venture exchange. So under the venture exchange, it actually is a regulated exchange, and so you get the benefit of a bid-ask, and so you are going to maximize, the value of the shares when you're actually putting them in the marketplace. The other thing, a lot of times companies, when they're small, will go into the OTC because they won't meet the listing requirements that you'd actually have to have if you went on to an exchange like NASDAQ or NYSE. Whereas a smaller business typically will meet some of the listing requirements on the venture exchange.
And I'll just offer my own observation there. So one of the things that we spend a lot of time with investors, and a lot of our work is trying to find that right balance between access to capital and investor protection. So trying to strike that balance, which is never an easy one in any country in the world. But that's something that we give a lot of thought to. And if you look at how we do that in Canada, we think we've created a marketplace where companies are doing quarterly reporting. Every share issuance that they do is reviewed by the exchange, and that is something that gives investors comfort. So where you might have something like OTC, which I might call a disclosure-based market, so you can disclose it, but investors have to look through the disclosure record to find it because it's within securities law. When you're on TSX or TSX Venture Exchange, just like NASDAQ or New York Stock Exchange, every issuance of shares is set to a policy, and investors have a level of comfort with that, and overall that helps to facilitate access to capital for companies. So let's talk a little bit about the timeline and getting ready to go public. So I'll put this one to both Bill and James. Maybe we'll start with Bill, but talk about what the companies need to do to get ready to be public.
Obviously we always talk about, planning is everything. The sooner you can actually get everything ready, have your financial statements ready, have your advisors hired. One of the things, when you are a public company, you are going to be required to file, quarterly statements, annual statements, MD&As. That's going to take time to do, so you actually have to have a process in place to close your books on a timely basis. And you really do have to meet kind of the requirements of the minimum disclosure, the continuous disclosure obligations that the company and the exchanges have.
So I think I'd also add that there are exemptions or some preferences for issuers on the venture exchange. They get exceptions from some of the higher standard obligations. So you get a little more time to file your quarterly and annual financial statements. You don't have to do a 10K equivalent. You still have to do a proxy, but the certification requirements on your financial statements, for example, are lower obligations. So there is some recognition that the obligations on the venture exchange, from a securities law perspective, should be a little lighter. But you should expect to have to set up a fairly robust regime to comply with your continuous disclosure obligations.
And I'll just add one comment. So, as a U.S. company looking at this, You do not have to re-domicile to Canada. It doesn't matter what country you're from. We're just interested in that the shareholder protections that are offered under that jurisdiction are similar to what Canadian investors would expect in our marketplace. So there's not a requirement to re-domicile to Canada, but what we do want people to know is that there are tax and structure issues that US companies need to think through, and that's why we encourage as much dialogue at an early stage with the exchange and some of the experts that can help advise you on what those matters are.
I was going to add one more thing, and James alluded to it when you talk about the disclosure requirements. We don't have SOX 404 in Canada. We have a national instrument that talks about certifications that both the CEO and the CFO have to sign off on. But unlike the US, where your auditors actually have to opine on the controls, we don't have that requirement in Canada. So again, it's a faster, slicker system. And as James also mentioned, if you're on the venture exchange, you won't have to certify that you actually have internal controls. And when you move to the bigger board, you actually certify that you have controls and they're operating effectively.
Great. So, we're here today. We want to get through these panel discussions as quickly as we can, so we're able to interact with people. And Bill and James and I and Michael and I will all be there to have conversations with people. So we do look forward to that. But just before we exit the stage, hopefully don't kill ourselves leaving the stage, but Bill, James, any last comments you want to make to the room?
I just think the venture exchange is an exciting place to be if you're thinking about accessing the capital markets.
I agree. But it's also not it's not a short-term decision to go listing. You should plan on a 3 to 6 month preparation process before you're ready to get there.
We'll take a question from the audience.
Before you guys leave, great talk, by the way. Back on transactions costs, however, could you comment on pre-deal what the ability is to do a test the waters marketing, and then post-deal, what's the ability to do follow-on transactions?
Okay, so in case anyone didn't hear that, I'll repeat the question just so we know. So ability to do, test the markets in Canada before the prospectus is public. So where do we start with that?
Sure. So there are some testing the water exemptions. As you'd expect, there are also concerns about gun jumping issues. So it's something you need to talk through on a case-by-case basis. There is some flexibility to have some discussions, but it's difficult. I'm happy to take the second question if you want.
Sure. Go ahead.
So the second question was about follow-on offerings. So the regime in Canada, from a securities law perspective, is a lot more flexible. So even as a venture exchange issuer, as long as you are short-form prospectus eligible, and all that means is basically filing a 10K, which is optional for venture issuers, you can be short-form prospectus eligible. And so one of the things about the Canadian market you may or may not have heard about is something called the bought deal, which is effectively a commitment from an underwriter to buy securities on the basis of an engagement letter with an obligation to file a prospectus within 4 business days. And what that allows people to do is actually issue stock from the date of signing the bid letter in about a 2.5 to 3 week process. So follow-on offerings are very efficient in Canada. Even on a marketed basis, there are overnight marketed deals that are very common and done in a fairly quick order. And so being a public company is actually facilitates raising capital.
So we have over 100 companies that started on TSX, added a New York Stock Exchange listing. We have over 50 that did that and added a NASDAQ listing. So, one of the points we make to people is when you're doing a listing, whether it's TSX or TSX Venture, you're going to go out and talk to a lot of the same investors as you would if you were doing your IPO just in the US. And this can be a way, of course, of building your investor base, and many US companies will look at it ultimately as part of a stepping stone to the US market. So thanks for your time. We're going to be around, and I'll pass things back to Michael.
Okay, Okay, as I mentioned in my opening remarks, the next part of our discussion here is one that hopefully you find really interesting. I do. And so I'm going to be engaged here for the next 20 minutes, and I hope you will too. We wanted to take this away from the theoretical and move to the practical. And so we've got sitting with me Rob Goring, who is the CEO of a company called RewardStream. You heard in my opening remarks that small companies, medium companies, and large companies go public and use our market. Rob is one of the smaller companies, if you don't mind me calling it a small company, that went public with us about 8 months ago. And so I want to talk a little bit with him about the experience and why you did it and that sort of stuff. Before we get into the experience, let's get into a little bit of who you are and some of the life you've had before RewardStream.
So, Rob Goring, CEO of a company called RewardStream. My background, about 20 years now, being a tech startup entrepreneur, started in consulting many, many years ago, and then actually started building companies both in Canada and the US. I've had offices up at Rocket Space in the city, had an office in a company in Santa Monica, so I've worked cross-border quite a bit, consulted for companies like Chase Mellon Bank in New York, but I've always been a startup guy at heart, and I love the whole startup thing, so I'm very, very pleased to be here back in this kind of environment. It's great.
And so you are not the founder of RewardStream. When did you join RewardStream, and how did that kind of come about?
Yeah, so I was brought in by the board in July of 2014 at RewardStream. It was actually founded in '99 by two entrepreneurs who are still good friends of the company, but they kind of went after the business in a very different way. So RewardStream is actually, we're a marketing technology platform. We're a SaaS platform focusing today on referral marketing. So we run the Refer a Friend programs for very large brands like some of the cell phones you're currently using, a lot of big telcos in Canada, mid-market financial service institutions, and also a growing number of small businesses through plugins into platforms like Magento, WooCommerce, other things like that. But the business was originally founded as a loyalty marketing company, a points program that was very 1.0, very custom software oriented, wasn't a high growth, wasn't a recurring revenue. And so I was brought in by the board in 2014 to really reconfigure the business and turn it around. So we kind of brought in a whole new management team. We restructured the business, we restructured the product. My undergrad and graduate degrees are in marketing and technology, so it's kind of my bend. So we rebuilt the business and then sought capital and took it public.
So as you look at the business today, let's just go through a couple of the very basic metrics. Number of employees?
19.
Revenues?
Just under 2 million.
Okay, so repeat that again for the audience.
Small.
Okay. And that's obviously an important point, which we'll get into a little bit more. Head office is Vancouver?
We're in Vancouver, yeah.
Okay. So you're sitting there 2 years ago when you joined, and probably a year ago more seriously, and this topic of going public comes up. Why does a company with, at that time, even less than 2 million in revenues, possibly want to go public?
So I've been on both sides. I've started companies where we've raised angel and venture money, and I've also done a couple of public companies. Right prior to joining RewardStream, I was actually chief marketing officer at a company mentioned earlier called TIO Networks. TIO just sold to PayPal for $300+ million. So I had been involved very recently in being a pubco again. The 10+ years prior to that, I'd had a couple companies where we'd raised $10 million US in venture angel money. And in that particular structure, had been sitting under 3 pref rounds that were tough as the entrepreneur to come out from under because we'd grown in sort of the slow growth years in the mid-2000s. So I had that sort of experience, not down on it, but it was just a different experience. When I joined RewardStream, what we had was a very powerful platform and technology asset, and we needed to get growth going. And so when we looked at raising money, the alternative to go public was really interesting because on one hand, and this is a small part of it, we had not a hairy cap structure, but we had a challenge on our cap table. We were all common pool, but there were a lot of common shareholders that had been around for a long time. There's a lot of very small ones. So we had 65 shareholders. So I came down here, talked to a bunch of venture folks down here and in Canada, and it was just a lot of shareholders to manage for a new set of investors coming in. We had a little bit of a hairiness in our option pool, which is very large, and we had people in the option pool that were no longer in the business. And there was no easy way to kind of deal with that. So going public kind of found an equitable way to manage that. But most importantly, it was access to capital and be able to get capital quickly in multiple rounds. And then kind of the third thing was really growth through acquisition. when I was at TO Networks, again, I've known the founder for 25 years, we've been buddies for a long time, and the time I was there, we architected 3 acquisitions that transformed the business, and I saw the power in being able to use the equity in the public company to go and acquire things. And in our business, in Reward Stream, in marketing tech, a lot of you probably know, a ton of venture money's gone in, and there's going to be there's a Series A, Series B crunch going on for a number of them. So there's going to be a lot of companies that are looking for exits or this technology or acqui-hire opportunities. So for us, that was a huge opportunity for us.
So one of the things you referenced was raising capital. On your Go Public event, you raised how much?
$2 million.
And if anyone of you have been following the story, you'll see that raised a little bit more money 2 weeks ago, 3 weeks ago or so?
2 weeks ago, okay.
How much was that?
Just under $800,000.
Okay, so you've raised sort of combined around $3 million. Let's talk a little bit about, I guess I want to go through 2 things. Let's first of all talk about the timelines here. We heard in the prior panel that going public can be quick, or quicker than in the US, let's say. So what was your timeline like from beginning to end or decision to close?
Yeah, just between 3 and 4 months.
Okay. What was the longest part of that? Anything in that bit that really dragged things or that took longer than you thought it would?
So one of the elements is you require audited financial statements. We had the benefit of having audits already done. So one of the board that preceded me joining had already put that in place. So that was actually very fluid for us. For us, the longest part was probably what they call the definitive agreement, which is negotiating sort of the bigger document that kind of has all the terms and conditions in it. But that wasn't even too bad. Honestly, part of what our challenge was is that like in venture investing, June, July, August are tough months. We started in April. And so we closed in July. So we had June, July. So it's a little more kind of herding of the cats in the summertime. But otherwise it was very smooth, very well organized, very efficient.
Okay, so you raised a couple $1 million when you went public, round numbers $1 million last month. Where's this money coming from? What sort of investors were you tackling or attacking, and how did you actually get to them?
So there's really 2 ways to look at it. When we raised money, again, there's 2 ways to do it. One is a brokered financing where you bring on a broker. The next panel, you'll have 2 of the best in the business talking about that. We ended up doing initially non-brokered financing. I don't think I'd recommend that to anyone. We had the capacity to do that because we had very senior people on the team that had done it. We had a number of people write checks. So we had sort of 15 to 20 high net worth individuals and family office type folks that were comfortable with that investment. Since going public, though, of course, we have a retail base. And so our retail base of investors are buying and selling the stock and managing it. And so there's a lot of, unlike when you're private, there's a lot of very interesting, flexible options to deal with, bringing shareholders in and crossing people out and moving shares around. So there's a lot of really cool flexible options. In our last round we did, again, it was very fast. It was mostly insiders, management, other folks, so we did non-brokered again. But I would, again, recommend for anyone to, again, talk to Blair and Jamie when they're here about doing a brokered round, because the benefit of the brokered round is you get a ton of support and they help the market.
So a company of your sort of size, you referenced that you're starting to get a bit of support from some of those brokers. How do you do that? How do you get on their radar screen, and how do you get on the radar screen of the investors?
Yes, I think with the brokers, it's important. It's like networking with angels and VCs, right? It's networking. It's building relationships over time. The old dots form a line. It's not a one overnight thing. You've got to say what you're going to do what you say, and keep doing that. I think in the public market side also, when you think I often think about private companies, it's like a small team sport. The public markets are a little more like an orchestra. There's more moving parts. And that's the benefit of having a broker on the team, is they will help organize and orchestrate those things. But one of the key roles can be an investor relations, public relations person, and they will help be the go-between between often the CEO and the market, and deal with a lot of the marketing of the company, getting it out to the public, getting it known to the public, and deal with inbound interest and things like that.
So we're hitting here on something that can scare a lot of founders, possibly or CEOs, this notion that you can't spend all your time running your business. You do have to deal with investors. You do have to deal with regulators. You do have to deal with bankers. You do have to deal with things that aren't immediately growing your business. So maybe just share a few perspectives on, from your side of things, how much time are you spending on that? How much time should you be spending, if it's too much or too little? And kind of just some tips on that kind of point.
Yeah, so I'm spending about 30% of my time on it, which is too much. And one of the reasons is because we did a non-brokered round. So the broker, again, would take on a lot of the responsibility that I've taken on. We're going to move to broker going forward. But the time spent is not bad time. You know, I'm meeting with investors on a regular basis. These are people that have invested over and over again, both in placements and in the market. They've brought people in. So it's, again, not unlike going to events like this where you're telling your story and you're meeting people and talking and talking and talking. So there's a lot of benefit to it. You know, but there's some structural requirements around it. There's some structure. So in Vancouver, there's a public market, you know, industry. So we go and speak to people on a regular basis. We go to Toronto, go to other markets. We did a roadshow to Europe. We're actually cross-listed in Frankfurt. So we actually have a big investor base of technology professionals out of Frankfurt, Berlin, and other areas, which is very interesting. So we went there and also marketed the company there.
How did that happen? How did you end up with investors in Germany?
So this is so James mentioned earlier about you know, doing an RTO, so a reverse takeover. So when we did the reverse takeover into the public company, it was a mining company that was doing what's called change of business. So the mining shell that we went into already was listed in Frankfurt and already had some shareholder base. But we also had a lot of contacts with tech entrepreneurs and e-commerce people out of Europe, and so they were very interested in it. And the European investors, there's a very large segment of them that are very comfortable investing in TSX and TSXV companies. They're very comfortable with the oversight, the regulations, securities, you know, rules, and they want to be able to get into North American opportunities. And I think that's one of the neat things about you know, US-based companies consider this alternative is US companies will automatically get a bit of a shine because you're based here. And even for Canadian European investors, getting access to a US domiciled technology company, again, there's a valuation bump there, which is kind of interesting.
And I think it's an important point that we maybe should have mentioned in the opening panel as well, though maybe you figured it out. But when you go public in Canada, if you go public in Canada, you're not actually restricted to raising money from Canada at all. Tons of money can flow in from other jurisdictions, whether you are a Canadian company or a US company, and that money in your case is seemingly coming from Germany, but it could just easily come from the US or from your backyard. And we have US investors. We actually just brought on a US board member out of Seattle, ex-Microsoft worldwide head of sales for a division, and he brought with him a bunch of US investors. They, in the way we did it, they required to be, you know, accredited US investors, and there's an extra form you fill out, but it's not onerous. It's not that big a deal. Okay, so we're going to move just to the conversation of some of the other benefits of being a public company. You've alluded to this a little bit, but we'll just talk a little bit more about what you witnessed at your prior company, TO Networks. So this was a business that's had been around for a long time and grew their business. And of course they raised capital along the way, as you have done, but they found other things that they could do, other ways to lever being a public company for their growth. And you started to do that a little bit with Nordstrom. Maybe you just elaborate a bit on what you mean by that.
Sure, so in TO Networks' case, again, TO is a bill payment processing platform, again, primarily serving unbanked, underbanked consumers in the US that are cash preferred. So how do you pay your bill at 11 o'clock at night before your cell phone gets shut off or PG&E shuts you off or what have you? So they built a series of kiosks and electronic you know, funding transfer mechanisms. But that's a high volume, high transaction, low margin business. So even though the company, when I got there, was transacting, you know, over $5 billion a year, it was low margin, but millions and millions and millions of transactions. So it's hard to get scale without going out and acquiring scale. So when I was there, we acquired a company out of back east in the US, a Canadian public company acquired a US-based company that had a money order business as well and was able to bring in $20 million of capital into the business that was on deposit for money orders and use some of that money to grow the business, which is very interesting. The financial, this is not a negative thing, the financial engineering of that transaction was amazing. TO was able to actually use money on the books of the target company to fund the acquisition. It was very interesting. The second acquisition was a company here in the Valley called ChargeSmart. ChargeSmart was an online bill payment platform for paying, again, with your credit card, paying your bills. And the third acquisition, again, was a New York-based company that was very similar to TO. And so in 3 years, with 3 acquisitions, they became the behemoth in the industry, caught the eye of PayPal, and then PayPal comes in and, you know, picks it up. For us, again, we're following a similar playbook. We are looking at acquisitions both to get us deeper in what we do, but also horizontally expand into adjacent markets, because again, in marketing tech, there's so much going on. You know, we do a very simple, you know, sort of referral marketing platform right now, but there's so much in personalization, artificial intelligence, machine learning around what we do, that picking up little bits and pieces here and there will help us scale much, much faster. And in my last company, when we were venture-backed, what actually ended up resulting in us kind of changing direction of the company is we couldn't get the board to agree on what to do. We wanted to butterfly and split the company and build one consumer version and one business version, and we couldn't get the board and investors to agree. So ultimately, we just shut one division down, and the two founders we left. We rolled out, stayed on the board, and we sold that later. But didn't give us as the founders the ability to go the direction we wanted to go.
So up to this point in this discussion, and really for most of the prior panel, you've heard all the amazing stuff about being a public company. It's not all amazing, even we know that. And so, Rob, let's move to some of the sort of challenges that you've had, and maybe the hardest part that you've witnessed in your 8 months as a public company CEO.
Yeah, the hardest part is probably the two things. One is the time commitment, again, and I would, for those of you considering talking, because the advice I would give again is use a broker, but it's all about the team. We had a great team, but I think there's always good advice on the people you bring around. The other thing is just being a public company, you are public. And so you have disclosure requirements. There's a certain amount of information that goes out about you, about your competitive stance. You've got a share price that kind of niggles in the back of your head. It's not always something you need to worry about, but it's something that's there. But a lot of it is, your competitive information can be out there. They talk about the MD&A, the management discussion analysis. The other things aren't that big a deal to put together, but you do have to disclose a certain amount more than what you do have to do as a public or a private company, which is nothing.
What about big surprises, positive or negative? But when you took on this role as now a public company CEO, anything that really surprised you?
I've done it a couple of times, so I was aware of some things that might come my way. There is, probably what surprises sometimes is the inbound level of interest from investors and the amount it sometimes takes to have those conversations and what you have to do to kind of assuage, people, because it is a bit of a, as an early stage company, there's a bit of a disclosure requirement. People always have questions, so I think, I had people DM me on Twitter asking questions. When's the stock price going to do this? When's your next press release? And that was surprising. Really? So then I asked my investor relations guy, I'm like, do I answer these? Well, you can't answer directly because disclosure requirements. So again, you got to be a little careful around what you can and can't say.
That's why you hire good lawyers to keep you out of trouble. We're going to wrap up in about 3 minutes, but if there's any audience questions, just shoot up your hand now or in the next 2 minutes and 59 seconds. I think there's one there. Yes?
You talked about, I was looking at your stock price and your volume. You talked about, are there any concerns about the low volume trading?
So I'll just repeat the question for everyone. It's a really important one. Thanks for asking. So any questions about the question is any concerns about the trading liquidity, the low volume in your stock?
We actually probably have more volume than most companies at our size. We're generally a couple 100,000 shares a day trading, which again, there's always a good and a bad to it, right? And the volume can be managed with partners. And so again, with the broker network, they can bring, they've got a team of people and market makers that will look at the stock and manage it, make sure that bids are being managed, that the buying is happening, and that things are being well regulated. We've got a market maker in Europe, for instance, that makes sure there isn't huge spreads between the stock in Canada and Europe, so that people don't end up in upside down situations. Liquidity is a different question. I think as a junior company, I wouldn't recommend you think about, as a founder, day one, month 6, selling all your stock and getting out. That's not, you often as a founder will be locked up. So for instance, we voluntarily locked ourselves up for 3 years. And the reason for that is to give the public confidence that the founding team, the engineering team, the management team, we're not going anywhere. You also, as insiders, have insider reports you have to file. So it becomes very public very fast when insiders are selling the stock. So I don't worry about liquidity too much because there are many, many partners and programs that can help manage that when it's important.
Okay, one question from the front here, and then we'll wrap up.
Hopefully, is this exchange also in this method a good recruiting tool?
So have you been able to use this as a tool for recruiting? That was the question.
Yeah, and it's a little different down here than in some other jurisdictions. Even in LA, it's a bit different. But absolutely, yes. I think we've a lot of people, again, especially when you see companies like TO Networks have the staff who all had stock options at 17 cents, end up it sells for $3.30. You know, that's a huge opportunity. When I first had my very first public company, I was telling Andy earlier, I joined at 17 cents and went to $6 in 9 months. You know, and we were able to sell the stock along the way. So it can be a very powerful recruiting tool. You know, some people had really great experiences with stock options in a private company and get an exit. Sometimes, you know, you end up sitting on options and never become anything, and so it's just paper you have. As a public company, there's currency, there's liquidity, and there's a way to get out. So it can be very powerful for recruiting.
Okay, so I'm going to wrap this panel up. I know you're going to be hanging around for questions afterwards, so anyone who didn't get a chance to ask, certainly feel free to come during the networking session. Final question, though, for you. Seeing the reward stream story, hearing it, sounds like it's pretty exciting, things are going well. Just tell us a little bit about what the future looks like for the business and how you see things growing.
Yeah, so when I took over, we were really a custom software enterprise play, and we've been able to standardize the product and bring it down market. We've recently plugged into, again, I think I mentioned Magento and WooCommerce from an e-commerce standpoint to give us distribution. We're going to be opening up to a bunch more platforms. So what's really exciting for us is very quickly here, we're going to be able to start self-onboarding and deploying, you know, true SaaS style, you know, marketing solutions for companies, and we've been able to build a huge pipeline in a very short period of time using the growth hacking techniques that you're all, you know, following and using. So we're very excited about being able to access capital to pour gas on now that we've, you know, kind of reconfigured and pivoted the business and we're ready to grow. So we're excited about pouring gas and pumping it up.
That's great. Well, thank you, Rob, for your candid remarks and thoughts. As I said, Rob will be around to answer questions afterwards. And if you're interested in learning how a reward stream can help your company, I'm sure he'd be happy to talk to you as well. So thanks very much.
Thanks, guys.
Okay, I'm going to invite the next group of panelists up. Come on up, gentlemen. So chairing this session, or moderating this session, is Andy Creech, who's the director in our office in Vancouver. And joining him are two key investment bankers in this market, Jamie and Blair.
Great. Thanks everyone for taking the time out of your day to attend this session. It's great to see such a good turnout. My name is Andy Creech. I'm Director of Capital Formation for the TSX Venture Exchange, and I'm based in Vancouver, BC. For those of you that don't know, just put it in perspective for you. On the TSX Venture Exchange, last year we raised $4 billion in capital. We do 60% of the business based in Vancouver. The other offices take care of the rest. And with us today, we're very lucky to have two individuals that helped raise a lot of that capital in the venture space market. We have Jamie Brown, the Vice Chairman for Canaccord Genuity, and Blair Jordan, the Managing Director for Echelon Wealth Partners. Today we're going to talk about three separate components, basically the building blocks for success for public companies and what they should be considering after they're listed. Also a couple of case studies, and then talk about the keys to some long-term success. So with that, we'll jump into the first part here, and question for you, Blair. What types of companies can successfully raise capital these days?
Yeah, it's a great question, and before I launch into what my thoughts are there, let me say it's a challenging question. I don't think there's any limitations, so I'm going to present a set of general ideas that I think most of us in the finance community in Canada would agree with, but there are always exceptions. So if you're an exception, don't leave the room. You know, there's a conversation to be had. So with that in mind, let's sort of talk about size, because I think that's one of the critical gating items that as bankers we look at. As a general rule of thumb, I think we'd like to see a run rate of about 10 million of revenue. You know, there are companies that get through with less than that. There are companies that get through with no revenue in some cases, particularly in the life sciences sector. That's an understood mechanism. If you're less than that, it doesn't cut off the conversation. But if you're pre-revenue and you're not in the life sciences space, it's probably not the right time to be public. Growth, I think, is something that we all want to see. I don't think we need you to walk through the door with that 30% growth a year that a VC's going to ask for. And interestingly, the public venture capital markets are probably not as enthusiastic about the proverbial hockey stick as VCs would be down here. Of course, we like to see growth. We like to see, you know, understand where value is going to be created for our investors. What we don't want to see is the upside down hockey stick where things go down after you list. But we do like growth. Sectors, this is difficult too. Things come and things go. I think things that are generally attractive to the investor base in Canada, though, have some tangibility or some ability for us to understand them. It's going to be difficult to access our market if you're bringing a concept or a product that is unfamiliar to both institutional and retail investors in our country. An example of that would be a consumer product that hasn't made its way into Canada. It's not going to be tangible. It's not going to be understandable for people. Sector-wise, obviously in Canada, you've heard it's a very large exchange. We list a lot of companies. We list a lot of international companies. So there are broad sectors that we cover, just as an economy. Things that I think we like, tech, I think software particularly, but hardware also. Life sciences, we're a very large life sciences market for sure. We've got a lot of risk capital there. Clean tech also is something that I think Canada does particularly well, and there's some very, very large clean tech companies listed in the renewable power space. Diversified, what I'll generally call diversified, an industrial company. We do a lot of real estate in Canada, and right now I think there's a particular fondness Canadian investors have for US real estate assets. Some of the other industrial things that are very strong right now, medical marijuana. We've probably got a slightly advanced legalization path in Canada there, and I think Jamie can probably tell you a lot about that. There's been a lot of companies that tap the market there very, very successfully.
Is there any sort of diversified or difference for funding for companies outside of Canada, or is it come on, come off from wherever you're?
Yeah, I mean that is a fair question. I think there are some jurisdictions where it's going to be more difficult for our investors to understand the value proposition or understand the growth. I think one of the questions that we batted around before we came in here was, is there a bar to foreign companies? The answer is absolutely not. The thing that you have to understand, and I think it's a lot easier for this crowd, frankly. I've done versions of this in other places where it's a little bit harder to explain. You have to understand and adapt to our market. We have governance requirements. We need to see people that we know and we understand when you come up and talk to us about an investment opportunity.
Excellent, thanks. So Jamie, get in here. Both of your guys' firms have institutional and retail desks. So can you tell us a bit about how those work?
Yeah, sure. There's two aspects of our business, the retail side and the wholesale. Wholesale representing the institutional marketplace, small cap money managers, hedge funds, family offices that are sophisticated. But the public venture capital realm, which can also be described as retail corporate finance, is very much deals under $10 million in size. And that is generated quite often through our investment advisor network, our broker-dealer model, if you will, for earlier stage opportunities. And that's very robust. And I think it's born out of the DNA of Canada's speculative mining, junior oil and gas market being one that was well understood. We have a large equity ownership in Canada, and I think there's this staid image of the Canadian banking system being very conservative. We managed to avoid the last global financial crisis from a banking perspective, but in reality, there is a very vibrant 40% ownership of equity culture that does like speculative opportunities, and we're seeing this risk trade on at the moment right now, and it's very much a retail focus right now for the smaller deal size.
Excellent, thanks. So Blair, what's the best way for people to access your retail desk?
It's a great question. So we both of us have large groups of brokers that work with us. So these are individual stockbrokers. I think in times past there was a lot of direct interaction in Canada, companies and stockbrokers. I think now it's pretty much universal across most investment banks in Canada. We would like to give you access to our retail brokers through one of our bankers, somebody like Jamie or myself. The days of them, companies going in directly to the brokers and trying to get deals done are pretty much over for most firms, and there's a couple of important reasons for this. Our brokers are entrepreneurs. They're like everybody in the audience here. They're building their own business, their own franchise. It's our responsibility as people that have provided them with a business platform to guard their time and their reputations very carefully. So we like to vet all of those transactions and make sure that it's worth spending the time on. At a more global level, reputationally, we really like to make sure that the deals we're putting in front of our brokers, out of respect for them and our own reputations with our internal partners, meet the standards that we have. And you know, it's been a fantastic experience talking to everybody today and down in Santa Monica, but sometimes there are ideas that are not quite ready for public markets yet. And getting those in front of our brokers is what we want to avoid.
Great. So you have your retail desk and institutional, and they're looking to put money into these public venture companies. But the question comes up, especially when on a go public transaction, in terms of pricing. So you've got your CFA there, Jamie. If you can talk a little bit about how, say, the retail investor values a company versus, say, a VC.
Yeah, I mean, many of the opportunities in technology, life science are the same discipline, approach, and methodology that a venture capital would take. We look at DCF, we look at price to book value. It's very much the future earnings power of a company. So there's the same kind of criteria that many traditional pools of capital look for. But I'd say in Canada, in certain sectors, we don't quite give the same virtue to top-line revenue growth as some of the U.S. investors do. We do like to see a path to profitability. I think there's a real concern amongst retail investors about young companies having a strong enough balance sheet and enough runway on their burn rate to manage the cash well, and that's a big consideration. So you know, we tend to focus a little more, I'd say, on positive working capital characteristics in the sectors we're talking about. But you know, on balance, it's a similar kind of multiples, maybe a turn or two down. For example, in a SaaS company in the U.S., you might be looking at a 7 to 8 times revenue multiple. In Canada, it might be 5 to 6.
Okay, terrific, thanks. All right, we'll switch gears a bit into our second section here and talk about a couple case studies. So perhaps, Blair, if you can sort of talk about a company you guys have helped access capital and a bit about the backstory and whatnot.
Yeah, no, happy to do that. So the company that I chose to share with you today is a company called Replicell Life Sciences. RP is the ticker. Replicell is a public company. They've been public for a while. As the name suggests, they're in the life sciences space. Specifically, they're in regenerative medicine, cell therapy. And they have a very interesting cell technology that they have just completed 3 phase 1/2 clinical trials on. And they've got a device that goes with it. So we've raised them probably a little over $10 million. We've done quite a lot of advisory work with them. And it's one of the benefits of brokering a deal. We've really embedded with them and helped them grow, and we'll continue to do that. Why did they seek public markets? Well, they are, as you know, phase 1 and 2 trials suggest, definitely pre-revenue. The revenue horizon for them is probably at least 18 to 24 months away. Life sciences works a little bit differently. Of course, partnerships is going to come up, and that's going to provide something. But access to capital, and there is that pool of capital that they went out and they've tapped very successfully in Canada. This brings me to a point on just comparing VC and the public route. So, you know, for them to go out and find the right VC investor, they were going to have to search long and hard. They were going to have to pre-screen everybody. They're going to have to sit down, and they're going to have to find that one investor that really understood their technology, understood their value proposition, had the cash, and was ready to make an investment. The public markets, the public venture capital markets, allow you to take that same preparation in terms of information and distribute it very widely. You don't need to find one individual or one fund with $10 million. You can go across a market and bring in a whole bunch of shareholders, a whole bunch of institutional investors. So that was something that was critical for them, and it's been critical for them as they've de-risked and moved along. They've been able to go back and raise more capital from those people. So that's another key point. The ability to refinance as they hit milestones or as they change their business focus was quite critical. That relates to sort of the third point, sort of efficiency of capital raise. There's also a governance question here. And I think that is actually very, very important. It's one of the reasons that when foreign companies come and talk to me, they're most interested in. We have very respected governance and disclosure standards in Canada on a global basis. Very transparent, very fair. The ability to become a public company, even if it's a small raise, we heard from Rob, and shine that light of governance on yourself actually really increases your access to capital. Everything's out there. It actually, in the case of Replicell, for example, increased their accessibility to strategic partners. This is disclosed disclosed, they have a relationship with Shiseido in Japan. That is a huge, huge multinational company, and there's a lot of dollars at stake there. Without that public disclosure out there, they may not have been able to achieve that. You know, the other side of this, on the governance front, frankly speaking, is, you know, when you're dealing with a VC, one of the earlier panelists mentioned this, you have a concentrated power base in your shareholder structure to deal with. It's much easier to pivot your business. It's much easier to go back and raise additional capital if you get short with a distributed ownership base. So those were all key things for Replicel.
Fantastic, thanks. So in this particular one for Replicel, it sounds like they've accessed the capital markets for cash so they can go and deploy that to grow their business, versus we heard earlier that TO used their shares instead of to acquire 3 companies to build their business along the way. So that's obviously a key benefit to being public. You can either use the shares to raise capital or use the shares as a currency to acquire other businesses. So Jamie, how about an example from you?
Given that we're an innovation center, I will stick with the pre-revenue theme, and one in healthcare as well. There's a company called Helios Medical Devices, which has a neurostimulation application to help treat neurological symptoms, including MS, brain injuries, and cerebral palsy. The company is interesting in the sense they took advantage of the reverse takeover, which you heard James highlight earlier. And it was a company that is based in Pennsylvania that found, interestingly enough, not a change of business, but another company that had failed in the same arena, and saw an avenue to introduce new management team, to new shareholder base, and raise capital. And over the course of their public life and through the reverse takeover, they've raised in excess of $30 million, and were also able to avail themselves of this efficient follow-on mechanism that we call a bought deal in Canada. We just recently executed on a $12.5 million bought deal for the company, which took the market risk out of the equation. We, as a principal underwriter, buy the position and resell overnight, do the due diligence after based on this short form offering mechanism and continuous disclosure principle. So it's a very effective, expedient way to tap the market when the company is coming off good news, which was the case. This company, coming off a 260 patient data set, is now looking at springboarding. It's ultimately now it's a $150 million market cap. It went public as an RTO at something less than 20 million market cap, which is a sweet spot segment for that kind of transaction. But now enjoys a $150 million market cap and is looking logically to the US markets and a NASDAQ dual list potentially. So they're now getting exposure from investment banks in the US and beyond. Great case study, and still in the process of enhancing shareholder value.
Excellent, thanks Jamie. We'll switch to our third category here, and just basically some keys to long-term success to operating in the public markets. So Blair, perhaps you know, in the months and quarters after you're listed, what are some of the things that public companies should be doing to maintaining access to capital, liquidity, and broker support?
Sure, no, it's a great question, because for anybody that's gone through an IPO process, both the company and the advisors, when you're done, you're like, oh my God, now we're done, we're finished. The truth is the work is really just beginning. So I think one of the key things that you can do as a public company to gain all of those attributes, you've got to communicate, you've got to execute, you've got to tell people what you're doing. You can't just go public and then walk away and take the money. You've got to tell people what you're going to do with the money, you've got to go and do it, and then you've got to come back and communicate to people. You've got to keep people interested in the story, and we'll touch on investor relations in a couple of questions, but that's a key way of doing that. You know, in terms of maintaining broker support, we've heard Rob talk about how that's important, and I think Jamie and I would both agree. You know, look, we're not charities. We are here to make money and help you grow your businesses at the same time. We have stakeholders just like you. So one of the things you can do is understand the economic synergy between us. We like clients that are generally loyal. We always like partnering up on transactions. The more people looking at a story, the better. But understand that when you continue to work with your broker, you continue to communicate with them, you continue to do the things that we'd like you to do. You know, when we put institutions into your story, when we put retail clients into your story, we want you coming back. I mean, to jump back to Replicel for a sec, the CEO of Replicel's in our offices probably every 2 to 3 months. Just giving us a material update on the business. So those things are critical, and that's what brings liquidity, it brings the ongoing ability to tap public markets. It brings ongoing broker support.
Excellent. So as with any relationship that we ever have out there in the world, communication is key. Talk, set expectations, and if you're not going to hit those expectations, obviously be clear communication as to what's going on and how you plan to rectify that. So Jamie, over to you. We've got a few companies in the room that are looking to hit this one out of the park. So and hit that unicorn status. And there's been some on the venture and TSX, in Amaya Gaming and Canopy and Knight Therapeutics. What's the path look like, and how can these guys get there?
Well, if it's medical marijuana right now, it's 35 times EBITDA multiple, so it gets you unicorn status quickly. It's a fascinating trade that's going on in that sector now. I've never seen capital formation as rapid and swift as that one, but each and every case that was identified there successfully tapped the market with the follow-on efficiencies of the market there on acquisition financings that they had identified, articulate use of proceeds, and executed in a momentum way to hit this bought deal mechanism again in all three cases. Maya in particular, 3 times acquisition size of the current market cap at the time. It was remarkable that a company in its category was able to pull off an acquisition financing and had a lot of unique characteristics and dynamics. So I think the common thread was a management team that had good relationships on the street, that had the right advisors, and that were able to avail themselves of the capital markets.
So just to follow on that, so they bought a company that's 3 times the size of the current market cap. They leveraged their listing.
Yeah, they did that in the combination of some pref shares, common, and debt. It was a gaming technology company. It was very much a momentum trade. They took advantage of a lot of volume in their stock, a lot of investor interest, and growth in EBITDA. So it was a fascinating case study.
So the small fish took out the bigger shark there. Good to hear. So Blair, back to you then. We've heard a little bit, and Rob talks about it. There's a lot of CEO time goes into telling the story and maintaining the story after the company's listed. When should a company look at doing IR type work? And
yeah, I think it probably actually starts in the go public process. I mean, you're out talking to investors. You form that relationship with them. Why would you give it up after becoming a public company? Just to pick up from the comments I made a couple of minutes ago, I think irrespective of market cap, and there are some smaller market cap companies out there, obviously well under $50 million, you need to be spending time on investor relations. Maybe the question we're really asking is, how much time should you be spending and what mechanism should you be pursuing? And that really scales, I guess, across the size of the companies. For a smaller but rapidly growing company where there's a personal connection with the investors, Rob just described it, he spends about 30% of his time, and that's probably been efficient for him. As he grows, I suspect we'll see maybe not a full-time investor relations professional join his team, but maybe he'll contract it out. And there's a robust community of people in Canada that specialize in working with growing companies from an investor relations perspective. As the company grows, there becomes a cost-benefit point where they decide to take on an internal investor relations person. The key is that you've got it and you keep that channel open. And I think there are very efficient ways to provide that investor relations support.
Great, thanks. All right, last question to bring it home. Jamie, back to you. What are some common mistakes that you've seen some companies made while they're public?
Well, we've seen a lot of companies go public too soon. Again, each sector has their considerations on revenue profile and growth trajectory. But just being good stewards of public capital is really critical for investors' confidence, and a lot of companies make mistakes chasing the top line growth with silly acquisitions and not being judicious with their balance sheet and making sure there's enough runway. As I think I talked to earlier, the burn rate management is a really key consideration if you're not positive working capital. A lot of these young companies aren't. And again, it takes a village. The small cap world is challenging at best. I think Rob is a testament to a very resilient, resourceful CEO that, in my view, not a lot of companies with that kind of profile have enjoyed the kind of success and access to capital that Rob has, so it's a tribute to him and his team. It's a bit of an outlier. So I think, again, companies going public too soon have to be very careful, but having the right advisors, having the right CFO, having a good board, good corporate governance, those are really, if you can stick and adhere to those principles, you're going to get an audience
Terrific, thanks. I think we got maybe 2 minutes, so is there any questions in the audience? Okay.
Does the owning Canadian shares run into trouble with FACTA, the U.S. tax law?
Does owning Canadian shares run into trouble with, sorry, FACTA?
FACTA, F-A-T-C, the U.S. tax law.
Okay, you guys familiar with that one?
Vaguely familiar, and the short answer is you should talk to your tax advisor. Bill?
Talk to your tax advisor.
Okay. Any other ones? Yeah, one back there.
When you talk about investing in foreign countries, we have Latin American companies.
Investments from Latin America or investments into Latin American companies? Yeah, we have raised capital for companies. Do you guys want to take one?
I would just say that the Canadian management teams and Canadian public companies have spent a long history financing assets in Latin America, particularly in the resource industry. We are starting to see evidence of other industries that diversified and technology that are looking. We just actually added to our New York desk Latin American specialists, so we are starting to see a pull demand from the investor community, Latin American growth. So it is an emerging trend for sure.
Yeah, I would actually echo that. We've worked with a lot of Canadian mining and oil and gas teams that have worked in South America particularly, and recently we've seen the same diversification. We're working very closely with a South American medical marijuana team, actually.
Yeah, we also listed Wide Dreams. It's a Brazil technology company that's in the advertising space as well. So with that, we'll be around for questions after as well, and I'll hand it back to Michael for some concluding remarks, and Dylan.
All right, so that concludes the formal part of our session. As you heard and seen the agenda, we're going to go to a bit of a networking chance now, so an opportunity for you to talk to a few more people and ask a few more questions. We've thrown a lot of information your way in the last 90 minutes. I want to leave you with just a couple of very simple takeaways. The first is, whether you're a small company, less than 5 million in revenues but growing, a medium-sized company, 5 to 50 million in revenues but growing, or a much larger company, there is a funding option in Canada that can absolutely help you. And as we said in our opening remarks, hundreds and hundreds and hundreds of companies raise billions of dollars every year in this. And so there's something here to think about as a complement to your existing funding sources or as an add-on or supplement to them. Second thing is, this doesn't have to be the end of the education at all. Every single person who's been on the stage today is willing to help out. Our contact details are on the back of the program. You should feel free to reach out to us. Those of you who want to can also follow us on our social media accounts, on LinkedIn, or on our Twitter account at TSX_TSXV. Source for additional information on an ongoing basis from there. The point is, this isn't a simple decision, and we want to be able to guide and help you as best we can through the process. And the hand thing is just for some final thoughts to Dylan in a moment. Obviously, as our guy on the ground, he can be very helpful to you as well. Before I do that, I do want to make sure we call out again and put a big thank you to each of the sponsors and partners whose logos are on the screens around us. Canaccord Genuity, Echelon, who you just heard, EY, Oslers, and Norton Rose. Very appreciative for all of their time, money, and support, and of course the local partners who helped promote this event and who helped host it. A big thank you to all of them. Dylan.
I wanted to thank everybody for coming as well. I'm the point of contact on the ground here for the Western U.S., and if you have questions, feel free to email me. You can get my card later if you don't have it. We're really doing a big push. I really think there's a big opportunity here to help companies. We're working with the VC community because they're coming across a lot of companies that either they have funded and the path is moving away from their focus or the opportunity they see, but they're good companies. There's also bootstrap companies, mom and pop companies that have been around a while looking to raise capital. It's a great alternative. So I want to thank everybody, and I guess it's food, appetizers, and wine. And, we can all mingle and network, and there's some great people in the audience here. I do see a few VCs. Maybe we can talk to them and founders of companies. Thanks everybody for coming.